Hi guys, James R, founder of Decisive Trading. In this video I want to look at backtesting. Specifically I want to go over a few different things. The first thing is we're going to look at, is backtesting effective? Then I'm going to go over a couple of the most common things I hear from people who say that backtesting is useless and ineffective. And then we're going to look at a couple of things you can do to help you improve with your backtesting and a couple of the reasons why it is so important. So the first point, is backtesting effective? This entire video could really be squashed down into a 10-second clip of me saying, is backtesting effective? Yes, it is absolutely effective. End of video. But I want to expand out on it a little bit because there are a lot of people out there who say that backtesting is useless. There's a couple of different things that I tend to hear in regard to backtesting being ineffective. The first point is that people say trading is completely random. So looking at historical price data has no bearing on what is going to happen in the future. Now, if you are just new to trading, that may seem like a sensible thing to say. But as soon as you start sitting down at charts and studying charts, you're going to see that these people do not know what they're talking about. If you look at historic price data on a chart, we're just going to take support and resistance as an example. You're very quickly going to see key levels of support and resistance used over and over again. The reason for it is, well, first of all, support and resistance isn't just these magical lines on your chart. Support and resistance represents price levels. And where key price levels are, so let's say level 7,000 on a chart. Let's say 5 years ago, the market rallied up into this 7,000 level and then it collapsed from that 7,000 level. Move to present day, the market is once again pushing up toward that 7,000 level. Now you've got to stop looking at these charts in terms of, oh, it's just candlesticks, I'm looking at this. It almost becomes like a computer game for some people. They're just looking at it. They're not really understanding what it is they're doing. Even when they are implementing a trading plan, they don't really think about what trading is when you get down to the foundation. Trading is people buying and selling. So if the market is coming back to this 7,000 level, and think about, not in terms of a retail trader, think about people in regard to people who have very, very large pots. So let's say someone looking after pensions. Let's say someone working in a bank. They are holding on to a long position in this market, and the market is coming up to this 7,000 level. Now, when they look at their chart, they can see that the last time the market reached this 7,000 level, buyers stopped finding value. They stopped finding value and the market collapsed. Now this person is holding a very, very large position and it's coming back up to the 7,000 level. Do you think this person is just going to, cover his eyes, put his finger in his ears and start going, la, 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 doesn't matter, I'm holding on to this position and I'm currently in profit? Absolutely not, because the 7,000 level, historically, is an area where, first of all, short positions have started appearing in the market, and secondly, people have started getting out of their long positions. They have to use that as the basis, or one of the bases, for their decision making. So what do you think is going to happen? Well, very often you're going to see people taking profits. Doesn't mean they just get out of their position completely, but at the 7,000 level, it's very likely you will then once again see that bearish reaction because people take profits. Short sellers start stepping in because they know in the past people didn't or no longer found as much value in this market at that level. And you can do it, you can do it with anything. If you simplify it down to, it could be absolutely anything. Let's think of marbles. You have marbles and you collect marbles. Now you've been collecting marbles for a very long time and you have this specific marble, and when you bought this marble, it was valued at £10. But before that, it had been all the way up at £20. And when it got to £20, the value of this marble had collapsed. I know this is an absolutely ridiculous analogy. Marble is the first thing that popped into my head, probably because I am losing my marbles doing these YouTube videos. But you have these marbles, you're using it as, you're collecting them, but you're also doing it as an investment. Now, you got them for £10. The value starts creeping back up again, and it gets to £18, it gets to £19. It's creeping toward this £20. Are you just going to blindly hold on to this marble? Are you going to think, you know what I'm going to do? I'm going to sell this marble because last time it was valued at £20, the value collapsed, and I want to make a profit on this investment. It's the exact same thing when you look at charts. You know, it's absolutely no different. You just have to think about human psychology. Now, that doesn't mean that every time a market reaches support and resistance, it's going to respect it. It's just, the support and resistance is just one part of what should be your overall trading plan when you're looking to execute trades on a market. Now, moving on from that, the other thing that I hear from people who disregard backtesting, and I've actually heard this quite a lot. It's probably because I mainly trade indexes and it has to do with floor traders. I've heard it at least, I'd say 10 times in emails. It must come from a book or a video or something. So if you do know the book that this comes from, please do comment below in the comment section, because I would actually quite like to read it. But what it is based on is that they have read about a floor trader who has said that when they went onto the floor of the exchange, just before they went on, they used to flip a coin, and depending if it landed on heads or tails, that would determine whether they were buying or selling for the day. And then what happens is these people, they expand out from that coin flip, and they take it to mean that if someone can flip a coin to decide if they're going to buy or sell, and they were a successful floor trader, it means trading is completely random. There's no point of having a trading plan. There's no point of backtesting. Although it sounds like they are thinking about what they're saying, they really aren't. They're taking this coin flip and they are extrapolating information out of this coin flip that is not there. When this floor trader says they flip a coin to decide if they're going to be buying or selling, well, let's look at it in terms of a trading day. A typical trading day for me, I would say 85% of trading days where I sit down at the charts, I am looking, or I am willing to both buy and sell a market. It's very rare that I'll come into a trading day and be thinking, I only want to sell into this market today. So what that is telling you is that, first of all, when you're trading, if you're day trading, I mean, the most common thing to be doing is to be looking for both buys and sells during the trading day. Now, this floor trader is essentially day trading. He's going on to the floor of the exchange and he's looking to trade. Now, think about it also in terms of the charts that we now have access to. We can sit in our bedrooms, in our office, whatever it may be, sit with a laptop and look at all these different charts, and we can have so much information on these charts and at our fingertips. We can be setting support and resistance levels. We can be looking at candlestick patterns, moving averages. You can be looking at things like convergence, divergence, whatever it may be that you use. Now, think of the floor trader. Put yourself in the shoes of this floor trader. You're going into a situation that is going to be very loud. It's going to be very stressful. People are going to be jostling and shouting and trying to trade over you. If you go onto that floor and you're only focusing on buying or selling, it makes it a little bit simpler for you. What it doesn't mean is when you flip this coin and it says buy or sell, it does not mean you just go onto the floor and start shouting buy. You just start shouting buy as soon as the market opens. I just want to buy, 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 buy. That floor trader still has a trading plan. He's still going to be looking at areas of value. He's still only going to invest his money when things line up the way he wants to line it up. He doesn't have the ability to sit and look at the screen, or, you know, I'm going back to when this was obviously written and this floor trader was talking about. He didn't have access to all the information we have access to literally at our fingertips, where we can just sit and click a mouse to enter the trade, click a mouse to exit the trade. He's on the floor of the exchange. So by flipping this coin, deciding buying or selling, it gives him the bias for the day. It allows him to drill down and focus his trading plan for the day and only look at specific things. It's important to understand that there's no floor trader, definitely no successful floor trader, who just walks into work in the morning, flips a coin, sees heads, and then just starts shouting buy as soon as they get on the floor. They would be wiped out very quickly. You have to have that trading plan. Okay, so moving on from that, backtesting. Hopefully just by looking at those two examples, I have showed you that backtesting is effective. Now think about when you are learning anything new. Unless you are an inventor, when you're learning anything new, what are you doing? You are looking at people who have done things similar before, or people who have done the exact same thing before, and people who are successful at it. And you learn off of those people. It's no different from when you're learning to build a trading plan. You're looking at historic price data and you're looking at how the market moved. And then you're starting to build a trading plan around what the market has done in the past. You know, if you don't backtest, I don't understand what you're going to do when you come to trading. I mean, if you're not backtesting, you're just going to be clicking at random, I'm presuming, and hoping for the best. It doesn't make any sense. With backtesting also, now, it allows you to develop your trading plan, but it also allows you to do a couple of other things. So what I want to move on to now is a couple of things that are going to help you improve in regard to your backtesting. And to do that, first of all, I have to look at a couple of different ways to backtest. Now, for me personally, when I'm backtesting, I manually backtest. It's very time consuming, I have to say, but it is the most effective way I have found. And what I mean by manually backtesting is I'll literally load up the charts, I will scroll left as far as possible on those charts, get as far back as I can, and then I will start to look at my trading plan and implement the trading plan. And what I will do when I'm day trading, looking at my day trading system, I'll run through every single trading day and I'll set everything up on every historical trading day, and I will look at the charts and I will mark down every trade that would have triggered the profit or the loss from that trade, and then move my way forward into the present day. Now, the other way that backtesting happens is that people use automated backtesting software. Now, I should point out here, what I'm going to explain now is my personal preference and the reasons why I prefer manually doing it. If you do use automated backtesting and it works for you, absolutely fine. When it comes to trading, as long as you're comfortable with something and as long as it works for you, you don't need to listen to anyone who's telling you anything differently. If you are consistently profitable with what you're doing, disregard what any guru, me included, I'm not a guru, I'm just a trader, but disregard anything that I say also if you are consistently profitable. All I'm trying to do is give you advice and things that I have learned along the way. Now, with automated trading backtesting, and the best way to look at this also is give you an example. Now, I'm sure you have, well, first of all, I sign up for almost every trading newsletter that I find, every trader that I find, because I like to see the information that's coming out of these people. And what you will notice as soon as you do that is you're going to start getting a lot of emails. Well, if you're getting emails almost every couple of days from someone who is a professional trader, and it just happens to be talking about profits and selling you something, you know, that's obviously a warning sign. But what you're going to notice is that a lot of these emails coming through are going to talk about brand new system. It's going to make you huge amounts of money. It has a 95% success rate, blah, 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 blah. What they have done is they have built this system using an automated backtesting software. And the reason it can be detrimental to actually trading is because it allows you to do the backtesting very quickly. And then it brings up all the information. And what you can start to do is you can start to tinker with it in very, very small increments. You know, you can start to change things like, okay, well, we had a couple of losses here. What is the common theme with these two losses? Well, they both happened on a Thursday at between 12 and 1 o'clock. So for this trading plan, we're now no longer going to take trades on a Thursday between 12 and 1 o'clock. And what tends to happen is they do that over and over and over again, and they're looking for perfection. And it ends up being using that historical data, they work it and they work it and they work it, and they get up to this 95% success rate. And then when it comes to trade into the future, it doesn't work. You know, there's so many different rules, there's so many different ridiculous things that they've built into this trading system that it just doesn't work. It just falls flat. And what you tend to see is lots and lots of losses coming very, very quickly. With manual backtesting, there's a couple of benefits. The first one is that when you are doing your backtesting, you're running through it manually, so you're looking at the charts every trading day. Now, it's going to allow you to start to see the ebbs and the flows of your trading system. It's going to allow you to start seeing the strengths and the weaknesses. Now, when I am doing manual backtesting, I will do the manual backtesting, and then I will look at the results and I'll think, okay, well, something common that kept jumping out at me was this, and then I'll go back and I'll alter it a little bit, and it'll become more perfected. But what it is allowing me to do is, first of all, I'm not trying to curve fit this information because it's just, it's just not possible. I'm only looking at the overall results and how the market is reacting each trading day. It's building into my trading psychology, which is one of the most important things in trading. It's building into that trading psychology, the knowledge of how the system works. So let's say this system is 70% accurate, and let's say you test it on the automated backtesting software, and it gives you this 70% success rate also. Two exact same systems. You look at the automated software, it tells you, okay, the worst thing you had was 4 losses in a row. Do your manual testing, exact same, I had 4 losses in a row, that's the worst thing that could have happened. With the automated software, you have not I guess you would say experience that. All you're doing is you're looking at it on a screen. Now, if you've taken any sort of trading course, and the trading course tells you, okay, well, we have a drawdown expectation of this, losing trades in a row of this, and then you just start to implement the trading plan without doing any of this back testing. What happens is when those losses start to come, you start to panic. You start to make mistakes. And because you haven't built it into yourself to expect it, all you've seen is on the screen it says, we're going to have 4 trades losing in a row. That's the biggest drawdown we've had. But when you start to live through it, it's a very different thing. When you are manually backtesting, you get to see these losses. You're literally writing down, okay, so this trade would have been a loss. Then you move on, you start setting up your next trade and you say, okay, well, this trade would have been a loss. And you're going to actually start to feel that little bit tightening in your stomach. You're going to think, okay, well, that's 2 losses in a row. You're going to mark the next one. You're going to get the 3rd loss in a row, then the 4th loss in a row. And then you're going to see the winners start to come back. And what it is doing is it is mentally preparing you for when that starts to happen when you are live trading. It's also going to start to pinpoint the strengths and the weaknesses in the trading system. Okay, a couple of ways to help you improve in regard to your backtesting. So the first one is to make sure you don't cheat yourself when you're backtesting. It's a very, very common problem. People do it all the time. I used to do it when I was first learning to trade. I don't know why we do it, but we do it. It just seems to be part of the human condition. And what happens is things like when you're testing your trading plan, you'll see a losing trade or a couple of losing trades in a row. They are part of your trading plan, but in your mind you'll start telling yourself things like, well, I wouldn't have actually taken this trade because of A, B, and C. I can see this was going to be a loser. It's not part of the trading plan, but I would know when I'm trading live that this is one to skip. And then what happens is when you start trading live, the markets are very, very unforgiving and you will just get decimated and you'll end up losing a lot of money. You need to approach this as a business, not only a business, but a very, very tough business. You need to be disciplined. You need to be very, very strict with yourself. Now, on top of that, when you're backtesting, one of the things you also want to do is try and make it as realistic to live trading as possible. And one of the ways I do that is that I make sure I cover a section of price action to the right of the screen. What I mean by that is, well, let's take day trading as the example because I mostly day trade. I will scroll back, let's say a year, 6 months, and I will have that 6 months or a year on the right hand side of the screen where I cannot see it. It will be blocked off. Everything that I do, so things like setting up support and resistance, has to be done only on the price action that I can see. So basically to the left of that 1 year of price action. What that allows me to do is set up as though I am setting up to trade into the future. Now, when we set up our charts to trade live, we can't see to the right of the screen. There's no price action. And if you are backtesting and you're looking at all of the price data, what happens is you're setting up your support and resistance levels as the example, and you can see what's happened. So obviously your support and resistance levels are going to be absolutely perfect. So when it comes to backtesting, you're going to be running through this trading plan and it's going to look like it's perfect. Or as close to perfect as can be, because all of your support and resistance levels are set on the price data that you already know has happened. Now, if you cover that section of the screen and only focus on the price action that happened before, it's allowing you to set up your support and resistance and then trade as though you're trading live and see how you would actually get on trading this trading plan. Now, it's very tempting when you do cover this right-hand side of the screen also to be setting up your support and resistance, and you'll do things like, well, this one, I just want to double check this one, so I'll just scroll to the right and make sure it is lined up, and then I'll just go back to not looking, and you'll scroll to the right, you'll line up this little line, and what you'll be doing is you'll be looking at all of the support and resistance areas, and you'll be mentally remembering, okay, well, this one's sitting round about here, this one's sitting round about here, then you'll scroll to the left, and you'll go back to, okay, I'm doing this properly, I'm being very disciplined, I'm only going to focus on this section of the charts, and you'll start putting your support and resistance levels as near to the places that you can remember as possible. That's the sort of things that your mind, that the voice in your mind is going to chirp up with and want you to do. You need to really, really focus on making sure that you are doing this in such a way that it is going to give you as realistic results as you can get with backtesting. Okay guys, that is everything to do with backtesting. As always, I hope that was helpful. I'm James Orr, and thank you.